So thanks the organizers for inviting me to attend the conference and discuss this very provocative paper, very interesting. So I'll share with you my attempts to digest the material in the time that I had to do it, and then provide a few questions more than comments or suggestions to Marcos. Just a usual caveat, but I don't think anything they'll say here will matter for policy at the Central Bank of Brazil. Okay, so what the paper does is to propose this creation of this global safe asset backed by a pool of emerging market economy sovereign bonds, but then also to be used by or to be carried by these emerging market economies and potentially by other investors. So the idea Marcos just presented at the end here, so this global safe asset is the senior tranche of bonds that are issued to fund the pool of assets that are carried in this vehicle. So the bottom figure there, sorry, where you have this emerging market sovereign bonds pooled into the asset of the vehicle and then issues liabilities to fund. The senior bond is the GSA, this global safe asset, and the junior bond is the one that would take the first losses. And then they argue that these emerging economies would benefit from holding these assets instead of safe assets issued by advanced economies, for example, US Treasuries. So the idea is in the spirit of this European safe bonds, which now have a different name, the sovereign bonds-backed securities. I'll stick to ISBs. So what I did was to start thinking about the design of the security. And then also I got somewhat curious about ISBs, and so I started there, okay? But the first reaction, and the same thing happens when you start thinking about ISBs, is that the proposal is really to do some pooling of assets and then trenching the liabilities. So in some sense, you're just combining risk and redistributing in a different way. So the first thing that came to mind was kind of a Modigliani-Miller type irrelevance result that I think is the first thing that I would think about. Okay, this should not matter in some circumstances at least. Okay, in some canonical reference framework, this reshuffling of risk should have no effect. And think of just some basic CAPM intuition. For example, if you just start adding portfolios of assets to the menu of assets that you have, that shouldn't matter at all. But we know that, for example, this type of irrelevance results requires conditions. So under some specific frictions or distortions, this kind of arrangement, could make a difference. And so I thought the natural script for the analysis would be as follows. So start with this sort of canonical world where you have an irrelevance result. Think of the frictions, so bring in the relevant distortions that you care about and that allow this asset creation trick through risk reshuffle to matter, and that's how you go about making the case. So I say, okay, let me start with ISBs, and then I'll go and try to draw some analogies with this global safe asset. So reading the work of ISBs, which is actually distributed in 2 or 3 papers that I found, the first one from 2011, you find precisely this idea that this will work because you have some specific distortions, okay? So here is from the 2011 proposal of ISBs. The list of all these virtues may seem first almost magical, which is kind of the first reaction. Okay, you're creating value out of something that in some world should not matter. So how can value be created by just repackaging bonds or repackaging risk? The answer to these questions is that eliminating the distortions brought about by bad regulation creates value. Okay, so there's a lot more detail, of course, in ISBs, but I think this paragraph summarizes well what's going on. As we discussed earlier, the bank regulation practices of accepting national sovereign bonds as riskless for capital requirements, together with ECB's generous haircuts, leads to a mispricing of sovereign bonds. By a government effort, this can be eliminated by directing the ECB interventions and the bank regulation risk weights towards ISBs. Value is thus created by moving to a different equilibrium, one that's supported by a pricing mechanism truly reflective of underlying risks. So here I think it's sort of goes the route that you would expect, that you have a reference where this kind of trenching and pooling would not matter at all, but then there are some frictions. Here, the argument is that these frictions are introduced by regulation that distorts the incentives for carrying these sovereign bonds. It attaches zero risk to assets that are actually risky, but the banks can carry the sovereign bonds and get zero weights attached by the supervision. And that's where the source of the problem is. And the other thing that comes out once you digest the ISBI's proposal, and in Marcus's presentation that I think was pretty clear, but in my reading I struggled a bit to spot it, is that what kind of risk you're dealing with, okay? There are, of course, fundamental risks having to do with fiscal policy of the underlying countries, but here the focus is really on risks that could be avoided altogether because are risks that are just created by sunspots. Okay, so here's also from their work. This is a different paper, this 2016 Sovereign Bank Diabolic Loop and ISBIs. A sunspot-driven repricing of the country's sovereign risk can result in bailouts of banks or other systemic financial institutions, which can lead to sovereign default. In the absence of such repricing, the government never defaults. Okay, so there's kind of a good equilibrium and potentially a bad equilibrium that you're trying to get rid of. That's the risk that you want to get rid of, and it's somehow requires bad regulation, so this distortion for this risk to show up in the first place. Effectively, the sunspot acts as a selection device among two equilibria, one with bailout and possible default, and another with no bailout and no default. A key condition for the first equilibrium to exist, and hence for the diabolic loop to arise, is that banks hold a sufficiently large fraction of the stock of domestic sovereign debt. Okay, so ISBIs can help solve a problem of multiple equilibria, where the bad equilibrium is made possible by bad regulation that creates distortions and makes room for the so-called sovereign bank diabolic loop. So that's how I then got to a point of reading the new paper by Marcus. And what I could try to do was to reason by analogy, okay? The paper is still a work in progress that is not exposed as clearly as the previous work that the authors, some Marcus and other co-authors have done. So drawing analogies for me was useful to try to understand what was going on in the new paper. So here, emerging market economies are subject to these sunspot-driven sudden stops that came out very clearly in Marcus's presentation. And what's the fragility that creates room for this multiplicity of equilibria is that households/firms have a currency mismatch. They borrow in foreign currency at lower interest rates and run a carry trade. And then there's a possible bad equilibrium outcome where there's a run on the dollar debt. There's no rollover of this debt. And if there are no sufficient reserves, there's a devaluation, okay? Large enough foreign exchange reserves can eliminate this sudden stop equilibrium, but that's costly. So basically, you have these private agents that are borrowing in the foreign currency at a rate that's lower than the rate at which they invest domestically. That's the carry trade, but is higher than the safe rate at which the international reserve that the central bank carries are invested. So the country as a whole is actually running a reverse, let's say, carry trade. It's carrying these low-yielding safe assets issued by advanced economies, and its citizens and firms are borrowing at a higher dollar rate, let's say. So the proposal would be let's replace these assets issued by advanced economies with this global safe asset issued by emerging market economies again, and these are created as a pool of bonds with the trenching to sort of have a cushion for the first, let's say, default events or devaluation event, and then make the rest, the senior tranche, safer. Okay, so you can clearly see the analogies here, and I think for those of you interested in this very interesting, provoking proposal to understand the ideas behind ISBIs, I think are useful to then digest the paper that they are working on. So I have a few, actually more questions than comments, given the production function for the discussion. So and here are a few of the questions, Marcus. Then we can talk about some others later. But so if in the case where we have enough foreign exchange reserves to eliminate the risk of a sudden stop altogether, so I don't understand why the insurance remains costly. In other words, how is this rate determined? This R upper bar money symbol here. How is this rate determined? I can see that in the data, if you go, that would fit the story, right? These agents are borrowing at dollar rates that are higher than the ones that you earn on treasuries, and they are low relative to domestic rates, and they're running the carry trade. But in the model, it's not clear. It seems now from your presentation, maybe I got the impression that this is exogenous and is set with a wedge. But in reality, we see it in the data that's probably reflecting some risk. In the equilibrium where you have enough reserves and you get rid of the risks, how come you remain with this interest differential that creates the cost for insurance? So that's one thing I don't understand. The other that's related, I guess, let's say for whatever reason, or you just want to look at this result that there are other risks that maintain this rate above the rate for treasury. So conditional on there being an insurance cost, why is the global safe asset preferred? Because then the reason here is through arbitrage. If you do create a global safe asset on the other side, that should yield the same as treasuries. So, okay, maybe you increase the supply of these global safe assets in the world economy, but I don't see how that would lower the insurance cost for the emerging economies, because those assets would still earn the same return as treasuries, right? As the assets that they are currently holding as reserves through arbitrage. So again, there are a few questions that I think have to do with exposition at the stage that the project is in. But overall, I think it's a very provocative paper on an important question. So what is the question here is, what is really the goal of this global financial architecture, the arrangement that we have currently in driving capital flows and sudden stops? Very dear issue for emerging economies. So the authors build on the insights of the ISB's proposal to put together this thought-provoking idea on the table, create a global safe asset backed by emerging market sovereign bonds. I would encourage the exposition based on this very basic strip that start with an irrelevance reference point, and then I'll say there are these frictions here and we can solve them, and it's better to do it with just say than reserves. And I look forward to seeing the future vintages of the paper. Thank you.